Good morning and welcome to our presentation on making sense of the Payroll Protection Program Loan Forgiveness. I'm Todd Harrington, Managing Partner here at Trout CPA. I'd like to thank you for joining us on the webinar today, and especially like to thank you for giving us the opportunity to serve and assist you during these unprecedented times. Like many of you, our employees are utilizing remote work capabilities to slow the spread of the virus while continuing to serve our clients. We hope that you've been able to connect with our team during this time. If you have not, please use the Q&A portion of the presentation to submit a comment, and we'll follow up with you afterwards to make sure that you've made that connection. We realize there's a lot of frustration and confusion around the specifics of the forgiveness portion of the PPP loan program. We share that frustration and confusion, as the SBA and Treasury departments still haven't provided necessary guidance. However, we're going to try to answer as many questions as we can this morning. We're recording this session. We'll be sending out a link following the webinar to the recording. We will have time at the end of the webinar for Q&A. Again, use that, there's a Q&A button on the toolbar at the bottom. It's a little box with a question mark in it. Use that to submit your questions. We'll answer as many questions as we can on the call today, and the questions that we don't get to, we'll follow up with you afterwards. Our presenters today are Robin Modine, Dan Choden, and Jason Herr. They're all members of our COVID-19 response team here at Trout. They've been working hard to learn the program and interpret the PPP loan program, both internally for our team and also externally for our clients over the last month. We recognize that many of you are facing personal and business challenges like never before. Please know that our team here at Trout is committed to doing everything in our power to help you and your businesses survive and thrive in this crisis. And now I'd like to turn the program over to Robin Modine. Robin is one of our tax partners and a leader on our COVID-19 response team. Robin?
Thanks, Todd. I appreciate that. We're going to dive right into this. We're going to try to get through our agenda fairly quickly. We really wanted to we were hopeful for guidance that came out today, as the screen says. You know, the CARES Act required that it was supposed to be out within 30 days. Well, I guess the government doesn't have to live up to their laws, but unfortunately we do. But it was supposed to be out April 26th. It's not here. I would say that as we sent out this webinar link, we were debating whether to continue having the webinar, but as we saw questions come back from clients, we realized that there were still several questions that we thought we could give pretty solid advice to, and so we thought it was still appropriate to probably move forward and to try to give you some planning ideas based on what we know, even though it's limited as far as the forgiveness piece. So next slide, please. So we're going to go through the overview of the Paycheck Protection Program. We're going to understand forgiveness of PPP loan, calculating the forgiveness, how and when a full-time equivalent is calculated, begin planning for the 8 weeks, and how can we help you? And we'll get to the questions and answers. Next slide, please. The Paycheck Protection Program, as you're well aware, was created by the CARES Act that was signed into law about 30 days ago. Hard to believe that we are now working from home. I think for me, it's been 5 or 6 weeks, and without any clear direction of when, we'll get the yellow light here, that more of us will feel more comfortable coming back into the office. But it's been that long, and it's been a month since the CARES Act was created. The SBA basically said the purpose of this was to provide an incentive for small businesses to keep their workers on the payroll. Some will debate, was it really to keep them on the payroll while I was able to be open, or was it to keep them off of unemployment while we were required to be shut down? And we can debate that one for a long time. I'm not sure. Hopefully, maybe someday we'll know. Maybe we'll get clearer direction in the loan forgiveness. The first round was $349 billion, as you're probably well aware. That started on a Friday. I think it was April 3rd, 13 days later. Hard to believe we spent $349 billion in 13 days, but that's what we did. And the money was all gone. The first round, there are some interesting statistics here. 1.6 million plus of loans. Average loan size was 206,000. We are currently on the second round of the PPP, 310 billion. I'm anticipating early next week, Monday or Tuesday, we're probably going to hear that that is now been used. I think maybe the only thing that's going to slow that down is some of the frustrations I'm reading by bankers not being able to get on the SBA's websites to put these loans in. There's a lot of frustration there in what you see and probably read on Twitter and other places. So next slide, please. This was from the SBA based upon the first round of loan funds. It's an interesting statistic. There is a bunch of other interesting statistics that the SBA put together. This is one I thought I'd just focus on to kind of show that, you know, it did really go a good percentage of this. If you look at it, under 350,000, what is that? Almost 87, almost close to 90% went to very small businesses, in my opinion, not large businesses like many would envision. We are seeing a lot of I'll say publicity currently, and I'll talk a little bit more about that with regards to these publicly traded companies getting the PPP loans and returning some of those funds. But generally speaking, if you look at this, a good percentage of the loans did go to small businesses. Next slide. Going to quickly go over how the PPP loan was calculated. I know many of you are probably aware of it. The reason for reviewing it is specifically the payroll costs are important not only on how you calculate the loan amount, but also the same payroll costs are used for calculating the loan forgiveness. So as you recall, we had to go through this exercise of what was our average monthly payroll cost, and monthly payroll cost was expanded beyond what I would normally consider payroll cost. It was kind of almost, not exactly, but it was close to an all-in cost for your employee. So it was gross wages, basically, not to exceed 100,000 annually. You know, it included the employer share of health insurance and retirement. It also included things like unemployment that you pay as the employer. That's the only state and local tax that I'm aware of that our employers pay in Pennsylvania. One of the things it does not include is qualified sick and family leave wages allowed under the FFCRA. So if you have employees that are claiming to stay home for family leave purposes because they have a child or something like that where there isn't school going on and you're paying them family leave wages, those wages are not eligible for the Payroll Protection Program payroll cost. You claim your credit for those through the FFCRA requirements, which is, you know, filing on the 941s. Self-employed individuals, we've gotten some clarification. Frustrating that some of this clarification came as late as Friday. The Schedule C net profit is not to exceed 100,000, and it doesn't include their health insurance or retirement of the owner. It had looked at their 2019 Schedule C. Partnerships, they did make a difference here, kind of surprisingly to me, between partnerships, self-employment income, where you're basically paying your Social Security. That's the same equivalent. Self-employment tax is the same equivalent as Social Security and Medicare, times 92.35%. And that, for us that prepare tax returns, basically what that means is you're taking your self-employment income and you're reducing it by the employer share of the Social Security and Medicare tax to figure out your share of it. But interestingly, again, they didn't note that on the Schedule C. We'll see if that gets further clarification or not. Next slide. Other requirements to receive the loan: less than 500 employees, had to be in operation on February 15th, can only have one PPP loan, certify that you'll use the funds for only certain things: payroll, mortgage, interest, rent, utilities. There were other certifications. Most of those certifications were fairly easy to certify to. You know, most of them were your background and those kind of things that most people don't have issues answering to. Next slide. There is one certification that, you know, continues. Unfortunately, it does continue to maybe give a little bit of pause and concern, and it became part of the whole part of the you know, figuring out whether you're eligible for this loan. And this was current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. You know, there's been a lot of publicity about public companies lately, places like Ruth Chris restaurants and Shake Shack getting these loans. And how did they get these loans? They're publicly traded companies. They're not small businesses. And technically, you know, by definition, they were allowed to apply. But basically what you're hearing from Treasury Secretary Munchin and coming from the SBA is like, hey, and looking at this frequently asked question, if you're not aware, the Treasury is publishing frequently asked questions on their website, updating it, and it's updated daily if necessary. I mean, it's updating, I believe, probably consistently every other day currently. And this came out last week, and it came out and it said, do businesses owned by large companies with adequate sources of liquidity? If we could go back one slide, please. Sorry about that. Do businesses owned by large companies with adequate sources of liquidity to support the business's ongoing operations qualify for a PPP loan? And what the Treasury say and SBA said, they said, all borrowers must assess their economic need. Borrowers must make the certification in good faith, taking into account current business activity and their ability to access other sources of liquidity sufficient to support ongoing operations that are not significantly detrimental to their business. So that's been a little clarification. I still feel it's a little vague. We don't have, you know, did your business go down 50%? Do you have so much liquidity that you can access? Public companies are certainly able to access publicly traded markets. I think I read that Shake Shack was going out and getting additional sources of equity and on the stock market, and they thought they could raise roughly somewhere in the neighborhood of $100 million to support them during this time. Obviously, most of our clients, I don't think we have any that are publicly traded, don't really have the ability to do that. Next slide. So this came up, you know, this question came up actually yesterday, and it said, do businesses owned by private companies, this is on the frequently asked question, with adequate sources of liquidity to support the business's ongoing operations qualify? And basically what SBA did was point you back to that previous slide of what I just said, that you were unfortunately in the same boat as the public companies, and we're supposed to assess our, you know, current need for based on revenues, I'm guessing, and liquidity. You know, Treasury Secretary, I think there's a lot of concern. As of yesterday, Treasury Secretary Munchin announced that any PPP loans over $2 million, the SBA is going to be doing a full review of that loan for loan forgiveness. That goes beyond what the banks will be doing. You know, if you saw headlines, they use the word audit. I don't know, you know, are they really going to audit it? Are they going to audit whether you're really required to receive it? What additional definitions are going to be there? You know, I really don't know. I think in my opinion, you still have to get back to, based on what it said in the previous slide, which was based upon your, you know, your current revenues and liquidity. Are you eligible, you know, to need this to support you for ongoing operations? And I would challenge you to think long and hard about, you know, if you feel the need to give this back, because that's one of the things public companies are doing. I would challenge you first to, you know, are you really thinking long-term enough? Because that's the one thing I just don't know. Nobody knows today how long this is going to go on. Nobody knows how long our revenue streams are going to be affected. We don't know if our revenue streams are going to be affected in the third quarter, fourth quarter, next year, or are they right now? Some are certainly right now for certain clients, but others aren't. Again, it's just really tough and challenging. I'm just putting it out there. I think it's something, as we'll have some further Q&A on this, that I think, you know, it doesn't hurt to put some pen to paper as why you felt it was necessary to have this loan. Next slide, please. The PPP loan forgiveness is an 8-week period. The first step to determine for loan forgiveness is the eligible cost. Payroll costs, we previously went over that definition. Interest on loans incurred before February 15th, lease payments, and those have to be on hard assets, so secured by hard assets, can't be an unsecured loan. Lease payments for lease obligations before February 15th and utility costs before February 15th. This is the list of utility costs we have to date. We'll see if we get more further clarification. If we don't, I still think there's some room for open interpretation, because there are some things like sewer, like why isn't sewer on here as a utility cost? I would think it's a utility cost, so we'll see what happens with further clarification. Next slide, please. This is a question that came up several times by clients, came up in the questions that to us prior to this webinar. When does the 8-week period start? Well, it starts when the lender gives you the money, basically, when they put the amount in your account. Do you take the cost paid during the 8-week period or cost incurred during the 8-week period? And again, this is another great question. And unfortunately, we don't have any guidance. All it says in the law, cost incurred and paid during the 8-week period. So the literal interpretation of that, which I hope it's not a literal interpretation, is I'm literally looking at utility bills and saying, or payroll, was it actually for that period of time when my 8 weeks started to when it ended? And did I actually pay it during that 8 weeks? That seems ridiculous that you would have to do that. I'm hoping for some leeway in that, but we'll see. That's currently the way it reads. If that's the case, I certainly see where the last day of the 8-week period we'll be paying a lot of things. Can I use more than 25% of the loan forgiveness on things other than payroll? This came up as part of the certification in the PPP application. You may recall that, and the answer is no. Only 25% is the maximum amount of loan forgiveness that can be used for non-payroll costs. Those costs like lease, utilities, the interest, those type of things. Next slide. Second step, and I'm going to really go briefly over this because Dan's going to go over this, and there's still a lot of, there is some certainty in here, and there's certainly a lot of uncertainty and guidance that we need in this. So the first step is you need to accumulate all of the eligible costs. So we like to say, all right, you put them in a bucket. All those costs are in a bucket. And then the second step is you come along and you say, all right, do I have to reduce those costs in the bucket by either the ratio of the reduction in full-time equivalents that happened in the 8-week period compared to either one of two periods, and Dan will get into those specifics. And if I did, okay, what is that ratio? And that percentage actually then reduces what's in the first bucket. And then it also says, you know, did I reduce an employee's compensation that is in excess of 25% in that 8-week period? And literally what it's saying in the law is that you're supposed to go back to the quarter before when you got the loan, which is basically the first quarter for most of our clients. That would be the first quarter of 2020, because the loans didn't start happening until April this month. You'd go back to the first quarter. And, you know, the questions are like, do you look at it in total? Do you look at it on an employee by employee basis? Still don't know. But the way it literally reads is you're supposed to take 25% of the first quarter gross wages and determine, did you reduce anybody's compensation in that 8 weeks? Parts that don't make sense, that don't make any sense are, do I take the first quarter's 13 weeks? Am I supposed to take 13 weeks? Times 75%, that's like 10 weeks. That doesn't make any sense when I'm only, paying in 8 weeks. There should be a comparison of 8 weeks in the first quarter to the 8 weeks that I got after the loan was made. And it's like, I'm hoping that's the guidance we get. We don't have clarity there. It makes sense to have that guidance. If we don't get guidance, it's certainly the guidance I would take, because then you really feel like you're comparing, apples and apples, not apples and oranges. So in the second step, this is the get out of free jail card, this note, the next step associated with the second step, generally will not be applicable if by June 30th you bring back your full-time equivalents to what they were on February 15th, or you eliminate the reduction of this compensation by June 30th. There's a lot of questions around this. The questions on the full-time equivalents are like, well, how long do I have to have these full-time equivalents by June 30th? Is it literally one day? Because the law says it's only June 30th. I doubt it's just one day. It'll probably be longer than that. Again, we don't know. I'd be surprised if you think you can bring your employees back on June 30th and the next day lay them off. That would be a surprise to me. That doesn't seem reasonable. I think there's going to be some period of time that they're going to want to see that you really did bring them back and you were going to keep them on the payroll. And if you eliminate the reduction, how is that really going to work? Like, you know, what about the fact that I might have to bonus some people? And what if they're actually, you know, paid more than, you know, the $100,000 a week equivalent in 1 week, which is $1,923. Again, who knows? It's really tough. It's challenging. We'll just have to see what happens as the guidance comes out. Next slide, please. Loan forgiveness considerations for Schedule C tax filers. They did make this pretty clear that for Schedule C tax filers, sole proprietors, and single member LLCs that file a Schedule C and they're not filing as an S Corp or some other form of entity, then you're basically just looking to your 2019 Schedule C net profit. You're dividing it by 52. It can't be over 100,000. Divided by 52 times 8. That's what's forgiven. On the front end, what did they do? They took, just like anybody else, it wasn't an 8-week period, it was a 2.5 month period, basically 2.5, which is close to 10 weeks, maybe slightly more than that. So what you got up front was certainly more than what will be forgiven, so you have to make it up with non-payroll cost. They have made it clear that those non-payroll costs must have been claimed, or you should have been entitled to claim them on your 2019 Schedule C. Not sure why you wouldn't have claimed them if you were entitled to. Highly unlikely, but that's how you make up the difference. I will throw one thing out here. We've had some debate as a group, and I'm just going to mention it because I don't know how it will all shake out. But the loan forgiveness definition of payroll costs was defined in the section where you determine how much you get for your payroll protection loan. And the guidance that we got on Friday basically went through this calculation, like I said, where you take 92.35% of a partner's self-employment income, can't be more than $100,000. And then it went on further to say if they have, you know, when they have employees, which most of them probably do, further went on to say that you only picked up the employer portion of retirement and health insurance, not the partner share of retirement and health insurance. So that makes one think there's the possibility that on the forgiveness side, because I know that that was not taken into consideration on the first round of loans of the $349 billion, that guidance wasn't out. People got Paycheck Protection Program loans on partner health insurance and retirement. And I'm just saying there is a possibility. I'm not 100% certain, but based upon how I put pieces together there in the law and doing this for a long time, that there's a possibility that when the guidance comes out, that partners may not be eligible to claim those two costs. We'll see. I'm hopeful that partners will be able to, but we'll wait for the guidance to know for sure. Next slide, please. The PPP loan amounts not forgiven. Following the date of disbursement, the interest payments are deferred for 6 months, but the loan interest still accrues. After 6 months from the date of your loan when you received it, the balance amortizes over 18 months, matures 2 years from the date of disbursement. You can repay it anytime, no prepayment penalties, fixed interest rate of 1%. So a very low interest rate. I will say that if you have a significant PPP loan that isn't forgiven, paying it back in 18 months might be, could be a significant amount per month, but hopefully it meant that you didn't spend the money and you could just, you know, pay it off. Next slide, please. Some other PPP loan consideration: qualified sick and family leave wages, which are eligible for tax credit under FFCRA. I said this earlier, they're not payroll costs that are eligible for forgiveness. You must claim those on the 941. That's where you claim them. The IRS Form 941, the quarterly payroll tax return. If you have payroll service providers, they should be helping you with that. An entity that receives this loan, the PPP loan, they're not eligible for the 50% employee retention credit. One clarification thing that we got maybe a week or 10 days ago was that an entity that receives a PPP loan can defer the employer's share of Social Security up to the date of loan forgiveness. So this is the ability for an employer to take their share of Social Security that is basically earned after a certain date. I don't remember the exact date. I think it was in late March. And that share up to the date of loan forgiveness, which could be potentially, I'm thinking this could be 4 to 6 months from now, potentially until you get your loan forgiveness, that share of Social Security, you could defer and pay it at December 31st, 50% of it at December 31st, 2021, and 50% at December 31st, 2022. The law was, I'll move on and say that the law was very clear that loan forgiveness is not taxable. But unfortunately, some commentators, and they are right, in the Internal Revenue Code, there is a section that basically talks about expenses associated to tax-free income are not tax deductible. We'll see what comes out of the guidance. Most of us are probably leaning towards the fact that, you know, loan forgiveness normally would be taxable, except for the fact that under this CARES Act, they made it very clear that it wasn't going to be taxable. So why wouldn't the expenses that are used for the loan forgiveness be eligible for tax deduction purposes? I'm hoping for that. That's what we hope for. We'll see if guidance comes out and tells us anything differently. Next slide, please. And at this point, I'm going to turn it over to Dan, and he's going to go through the loan forgiveness calculator. Thank you.
Thanks, Robin. My portion here, I want to take some time just to review our tool that we published previously, and would certainly encourage all of you to take some time to work through this. We'll continue to be utilizing this and updating it as the new guidance is released to just keep this very valuable and as practical as possible. The whole purpose of this is just to give you an estimate of what you can expect to have forgiven on the back end of this loan process. And from there, enable you to plan your costs and to take some steps, hopefully, to maximize the amounts that you can have forgiven in the process. This is here in our slides, just as some screenshots. It's also available on our website, and there'll be a link in the slides, and the slides will be available after the webinar as well. This starts with your loan disbursement date and the loan amount. When you get your funds is what drives this 8-week period, of course, as far as timing goes. So you want to be watching those costs within that 8-week period. And of course, we're still waiting on what incurred and paid means, but for the purposes of planning, I'm telling clients to focus on what's paid at this point, and if that needs to be adjusted down the road, it'll be adjusted, but we'll start with what's paid and then move forward from there. The payroll costs are where we start with, and Robin had already put this information out on what those categories are and the other expenses as well. So what the calculator does is it kind of defines and categorizes all the information we've seen in previous slides in one place to be able to see what those are, some directions on those items, and then be able to also force yourself to consider the 2 limitations on forgiveness as well, should they apply. We have the main summary tab in this spreadsheet, and then we also have some separate tabs for further calculations supporting this information. And so we'll get to those. The one things I wanted to highlight here was the gross wage amount and the reduction. It's a little easier to say, okay, I've paid my employer portion of health insurance, retirement, the state unemployment taxes, and those are easy payments. But when it comes to wages, it can get to be a bit more confusing. If you're in a situation where you're paying employees that aren't earning high wages, they're all under 100,000, then it's pretty simple. We just start with that gross wage number to the employees and don't have any reductions. But in the payroll expense section, that second line is a reduction if we do have anybody over that $100,000 per year amount. And those are broken down into either $1,923 per week or $15,384 for the entire 8-week period. Those are the breakdowns of what $100,000 annualized is during this time period. So we want to be careful, and that's probably the most confusing part of this as I've talked to clients, is that we have to really manually go through payroll run reports to understand, do we have anybody over those thresholds, and make reductions to their gross wages specifically. So a little bit of a tedious process, but something that needs to be done nonetheless. In our other expenses, we talked about these already, have gotten some good guidance on this. Initially, we thought interest and rent really seemed geared towards real estate. It talked about mortgage interest, but that definition has been expanded. It talked about interest on real and personal property, and examples that have come out since the law have talked about an auto loan, which I certainly never would have thought of as mortgage interest in the traditional sense, but for the purposes of PPP loan forgiveness, an auto loan was an example in the self-employed guidance that came out to be able to say that's qualifying interest. And the same thing was true of rent. There was some concern whether that would just be for real property or whether that would be open, and examples also included an auto lease. And so that kind of leads us to believe that we're talking about any lease agreement that was prior to this date should be qualifying just based on what we've seen so far. We have another slide here that'll further delve into some of the utilities here on this point. So that's the top half of our calculator. The second half covers the two limitations on loan forgiveness. So we can go to that next slide. Each of these calculations has a separate tab that covers them more. What I really want to highlight here is our first footnote down below, though, because we can get into a lot of weeds on what are we doing in these 8 weeks and for these two limitations. And that's important. We should go through those steps and understand those processes. But this first footnote is important. If you have a reduction in your full-time equivalents during this time, that reduction can be disregarded if it's eliminated by this June 30 date. This kind of fallback safe harbor, I can call it. If you get everybody back, you get your head count back by June 30, get your compensation to where it was by June 30, we will be okay. And we're going to need a little more guidance, just like Robin said, on what June 30 means. Payroll covering that, payroll closest to that. Probably couldn't just be a single day. So we'll need to understand what that is more so. But don't pull your hair out too much if you're struggling with these two initial calculations, if June 30th is a more realistic timeline for you. But each situation is going to be very different, and I've certainly seen that already. So we'll talk a little bit more about these two reductions on the next slides, but let's go ahead and jump now to the utility slide and the breakdown of that. Next up, thank you. Here we have what was specifically listed in the law, and then also just a little bit more guidance on what we think this can mean, because there's certainly a lot of interpretations of what traditional utilities can be on top of this. One thing that came out in the self-employed interim rule was gasoline that's used in a business vehicle was considered utilities for the purpose of that forgiveness. And we believe that should apply beyond self-employed as well. And that really opens things up, and maybe that opens things up to other transportation costs, tolls, parking, maintenance even, or a mileage reimbursement. It's pretty open-ended if they're including that. And again, not something I normally would have thought as a traditional utility cost, but we want to be considering everything that's possible in this. And when I talk to clients, I talk about it in the terms of, well, let's first start with the cost that we know, and let's also have a maybe bucket to be putting every other cost in until we get that further guidance. We want to be aware of these other things. If there's still amount of unclear issues towards the end, we may even still be submitting items that aren't completely clear or not specifically excluded to the bank. And so we want to monitor that maybe bucket and just be keeping that separate category of costs understood. And so that's what our catch-all category here at the end of utilities is for as well. Just consider what else may be arguable and maybe is addressed in further guidance as well. So let's go on to the next slide here and talk more about the haircuts that are out there, the limitations on forgiveness. A lot of questions with clients have come surrounding the full-time equivalents, and another tab of our calculator just deals with calculating those and understanding these for the two look-back periods that are possible. If you've dealt with the Affordable Care Act, this is going to look really familiar. These are basically the same rules for what is a full-time equivalent for the Affordable Care Act as we're dealing with here. Still more to come on the timing when we're talking about as of February 15th and as of June 30th. Full-time equivalents doesn't make as much sense then, but what we can do today is at least calculate these two look-back periods and then understand what are our goalposts. If we hit certain FTEs within the 8 weeks, are we good with the look-back periods and the 8 weeks, or do we have to go and look to June 30th? And that's going to be an easier number for us to hit. So planning for that now is something that we can do, and then we'll get more clarity on that as it moves forward and we do get more guidance. But I did want to just address on this slide just what this means and what this calculation is. A lot of confusion can happen in that area. A full-time equivalent for this purpose is someone who works 30 hours or more in a week or 120 hours or more in a month. And so what we do is take this first green row and add up everybody is just a full-timer working 30 hours or more in a week, 120 hours or more in a month, and total up those numbers of employees, and they're one full-time equivalent each. Then we have to take the hours for everybody else. Everybody working under 30 hours a week and under 120 hours per month falls into the second bucket, that second green row. So we add up all of their hours worked, then divide it by that full-time equivalent threshold of 120. And there's our two categories, our part-time full-time equivalents and our full-time equivalents, to get to a total and then an average total for this look back period. So this gives you an opportunity for some planning as well, understanding that you want to maybe bring your full-timers to a 30-hour level or bring your part-timers up to a 30-hour level to maximize your full-time equivalents during the 8 weeks or during the June 30th window, whatever that ends up being. Because you go run into an interesting situation where you have a person that works 30 hours and they're worth one full-time equivalent, and that same person could work 100 hours and they're still just worth one full-time equivalent. So if you can spread that workload out amongst multiple people, you could have the same hours or similar hours paid and perhaps increase your calculation and reduce any limitation. So this is a great piece of the calculator, something we can do now, at least at a high level, understand what our goalposts are to try to aim for the forgiveness. And jumping to the last slide of our calculator next, this one relates to our compensation reductions. And this caused a lot of confusion. We've had a lot of client questions on this one as well. In a lot of cases, clients can not even worry about this slide. This only applies when you have employees that you have cut their rate of pay or just significantly maybe reduce their hours. So what they're making prior in Q1 is significantly more than what they're making during this 8 weeks. If you're close to the same or they're not making any less on the rate of pay, you probably can just ignore this slide altogether. Our interpretation of this at this point is that this is a per employee look at the 8 weeks compared to Q1. There's a lot of arguments about this right now out there in the professional community, so different interpretations can apply. It's hard to say for sure until we get to the final guidance. So I don't want to say this without that disclaimer, of course. But the big thing here is if you're paying people roughly the same, or their rate hasn't changed and their hours are roughly the same, this is probably not going to be an issue you need to worry about, at least at this time. We'll have to revisit it as we get more guidance. So that just about wraps up the loan calculator. I'm going to go ahead and give it to Jason now to talk more about some planning opportunities that we have.
Thanks, Dan. Yeah, I'll be talking here about planning for the 8-week period. Before I get started, our moderator, we're going to try to do a polling question. Our moderator will put a polling question out, which is really this question towards the bottom of the screen here about bringing employees back. So if you can answer that, we're going to try to do a poll on that, and then I'll give feedback on the back end here related to that. So first I want to talk about accounting and reporting related to the loan. A lot of questions about, hey, I've been hearing about needing a separate bank account. From our perspective, that's not a requirement, although some banks are requiring that, and also many attorneys are recommending that. So we generally have been recommending this just from an approach of excess caution of handling the money. And with our experience on compliance and dealing with IRS auditors, often they like to see a cash trail to follow. So with this, you would try to, if you can't get costs to come directly out of that account, you would try to time transfers over to your main accounts when the qualified costs are paid. But again, it's not a requirement that we've seen. For the actual recording and accounting of the loan itself, we recommend a separate general ledger account set up as a long-term liability that clearly identifies it as a SBA PPP loan on the balance sheet. And then you just let that sit there until the forgiveness amount is officially determined down the road here. Accounting for the costs. So you can continue to use your current account structure. However, some clients are setting up new or separate general ledger accounts as an extra measure, which that's fine or good. Your general ledger system may be able to tag costs for a specific use. That might be a more efficient approach, or could just use a separate Excel spreadsheet. Really, you just want to be able to clearly extract the data supporting the cost during that time period. I want to talk a little bit about handling of staffing and payroll. There continues to be a lot of unanswered questions in this area. We'll address this a little bit more too in the Q&A, where we had pulled some questions that attendees put in when they signed up. I know there's some in there about bonus and hazard pay. So we get a lot of questions like this one that we just put on the poll. Should I bring back my employees back onto payroll once I receive my PPP money, even if we do not have work for them? You hear things in response to this like, yes, you need to do that, or this is within the spirit of the law, or no. Some attorneys are even saying, no, it's not recommended actually from a legal perspective. So I know that's frustrating. You're hearing things that are all over the place. With uncertainties like this, we generally lean towards continuing to operate your business as you normally would and not take an action, a different action, just to try to adapt to a government program. This, of course, may lead to having a loan to pay back or a portion of a loan to pay back. But from the business cost standpoint, you'd want to analyze if that's really any different than just paying payroll. Unfortunately, there are risks on either side of this since they have not given good guidance on it. On the back end, if you wait, you could hurt yourself because of the reduction calculations that Dan went through. So we just question how it really helps anyone, the employee, the business, or the government to bring back employees for unproductive labor. A few reasons maybe to consider bringing them back. Maybe it helps your culture in some way, or your relationship with those employees, or you might have other aspects of the business they can help with. So those are kind of like non-financial reasons too. A financial reason might be if you have significant non-payroll costs that qualify for the forgiveness or might qualify, you may be more inclined to bring them back to help increase your 25% forgiveness bucket. So if you haven't thought through that, make sure you're thinking about that. Then some just other ideas and considerations on the payroll side. Consider managing, if possible, your full-time equivalents. In that, could you increase part-time workers and decrease full-time workers' hours so that you get more full-time equivalents, bringing those part-timers up over the 30-hour mark? Could think about that. Cell phone reimbursements and policy. We've had a lot of questions about that. Could you implement such a policy? Something to consider or think about since it really probably falls into the utility costs. Would you need a policy before February 15th? Most likely, it's hard to say. Just trying to get your mind churning here. Also, adjusting health insurance so that the employer covers more of the premiums. So if you're in a situation where you don't cover, the business does not cover 100% of the premiums, could you bump that up? And then it would almost be like an added incentive or really just a bonus to the employees. But it could also help with employees that are in excess of 100,000. Going back to that limitation on Dan went over on the calculation, could help get a little bit more there on the forgiveness. And then consider a special payroll before the last day of your 8-week period. Hopefully, by that time we know more if that would be needed or not. Next slide, please. Dan already really went over the calculations, and really I'm just encouraging again to take time to work through projected calculations now, estimating out your forgiveness period costs, and determine your base period FTEs a while. And then as you go through this 8-week period, track and keep documentation related to the spending of funds on the full-time equivalents and on payroll by employee. It's better to do this as you go versus on the back end. Next slide, please. So how to plan for costs that may qualify but are not clear. Dan kind of mentioned this too. So the suggestion I'm giving is first identify and project out clearly qualified costs. And Robin and Dan went over those. Then if you have a remaining forgiveness bucket or forgivable amount, consider, are there steps or strategies to increase those clearly qualified costs, especially on the payroll front, that are good for both business and employees? Then, once you've exhausted that step, separately capture uncertain types of costs. I really think, although they will give more guidance, that there's still going to be unanswered questions. I mean, I've even had questions in the last day or two that I don't think will become completely clear on very detailed items. Wanted to spend a minute on application for forgiveness. I just think it's good for you to be aware of the process if you haven't looked into that already. According to the law, there will be a process of applying for forgiveness through the bank. It is not yet clear exactly when the application needs to be submitted. It'll be driven by each bank, and we have seen with certain loan agreements from different banks where they are have a date to apply by. The ones we've seen have generally been 90 days out. And then the bank has 60 days to issue a decision on the forgiveness. So it's like Robin says, it's going to be a while, and then who knows how long the SBA takes after that. I really hope by mid to late fall, everyone knows where they stand on the forgiveness, and certainly hopefully by the end of the calendar year. And just regarding the mindset on when you consider this whole process, practically, I envision this being a slightly different mindset than when you were applying for the loan. When you were applying for the loan, applicants were guarding against making sure not to do something that would kick them out of the pool of loans altogether. Whereas when applying for forgiveness, you're not as worried about that and more just worried about, hey, will certain costs be kicked out or excluded? Certainly you don't want to do something egregious or fraudulent in any way, of course. And if you're of a conservative mindset, maybe you want to avoid putting questionable costs in there altogether. However, if your forgiveness bucket is not filled, maybe you want to lean more on the side of initially including costs that are not specifically excluded. Cell phones, we've had a lot of questions on the portion of mileage reimbursement related to fuel, dental and vision on the health insurance side, things like that. On timing of incurring and paying costs, I know I've talked to some of you about this, but until there's further guidance, why not plan to try to incur and pay qualified costs within the period where it is reasonable to do so? So if you have costs falling just beyond the final date, try to plan accordingly. As you get down to the end of that 8-week period, really focus on your AP and getting things paid. The intent of the law seems basically to cover two months worth of these operating costs. But depending on the nature of your costs, maybe there's some you can get in there that qualify, and you can kind of manage it. Likely, it's difficult to argue more than 2 months of core costs, such as health insurance and rental payments. But if your window timing allows you to defer or accelerate a payment, what's the harm in doing that if it's just a cash flow timing difference in case it does qualify? It's hard to control when you incur costs, but certainly more control when you pay costs. And then that last bullet there, covenants, I'm sure you've been thinking about this, but just make sure to consider the impact of having this additional loan on any bank covenants that you already have in place. Debt to net worth, debt service coverage ratio, net worth covenants, maybe even borrowing base impacts. Next slide, please. On this slide, just wanted to throw in there, because we have had a lot of questions on, hey, what kind of documentation will we need for the forgiveness applications? So this slide here is actual details straight from the CARES Act that I probably have provided to some of you already in our interactions. Other than I did paraphrase a couple things that are in italicized. So this is initially what you'd want to be gathering as you go along, and the banks certainly may require a little bit more. Next slide, please. Okay, so how can we help you? I'm also trying to update this poll here and see if I can get that to work. I'll go over that here first. So on the poll, I guess I have to do live math. 40% of folks said, yes, I brought my employees back. And then about the same amount, maybe a little less than that, said, no, I did not bring. And then third is, I don't know. So maybe you didn't get to that point yet, or it doesn't apply to you. So how can we at Trout help you? We've really been trying to connect with you proactively during these difficult times, and just, we really are trying to just help people, and also, of course, lifting you all up in thoughts and prayers in the process. But we want to support you wherever we can, as Todd mentioned, and we're certainly trying to respond to you as quickly as possible when you reach out to us. So just continue reaching out to your points of contact here at Trout. We do have a significant number of resources at our website. We just have a lot of opportunities and resources we can pull together. So what we've done is try to pare that down from all our resources down to what we think is most helpful and gotten that out on our website. And of course, as you go through the forgiveness calculations, we'll be here to support you in that, both on the front end here as you have questions on projecting out, and on the back end when you're actually pulling the data together for the application. And overall, I'll just mention, while we can't always give definitive answers because of lack of guidance, which is where we stand today, we often find we're either able to reinforce your thoughts that you might already be having, or lead you to a decision point, or maybe in a different direction from where you were going. At this point, we will be switching over to going over some Q&A. Some of these are pre-prepared based on, like I said, feedback coming in on the front end of registering. Nikel's going to lead us through that.
Thanks, Jason. We have been receiving a lot of great questions in our webinar today, and we'll do our best to get as many of those answered in the remaining minutes that we have. Those that we don't get addressed, we will follow up post-webinar with answers to your questions. Our first question: when accumulating expenses for the 8-week period, do we use the cash or accrual method?
Thanks, Nikel. Hey, we went over this at the beginning, and unfortunately, again, this is that section of the law about the incurred and paid. Accrual is under kind of this incurred. We incurred that during that period of time. And as it currently stands, all we have is incurred and paid in the 8-week period. I'm really hoping for some leeway. And one of the examples that I saw with leeway on the front end when we were getting these loans is, if you actually read the law, and I know I'm boring, I read it. I read the law and I said, hey, the law said that I'm supposed to take my payroll costs for the 12 months up to making the loan. And so us as practitioners were sitting around a room and saying, well, that seems like a moving target, because I don't know when I'm actually going to get my loan, because I have to go through this process of applying, and the bank has to approve it, and making the loan makes it sound like till it's actually in my bank account. So it didn't seem to make sense that literally you would be calculating it all the way up to the date when you got funded. But we thought, okay, realistically, it could be the 12 trailing months before you applied. That could be realistic, that you would look at that period. But as you saw, what did Treasury do? They said, well, you can do that if you want, but we'll make it even easier for you if you just look at 2019. So I'm really hopeful that we get leeway here. Seems crazy to me that literally you would have to be looking at payrolls and saying, okay, what was actually incurred in that first payroll that we ran? And do I have to run a payroll on the last day of the 8 weeks? And we may have to anyhow, I don't know. I mean, so it just seems a little crazy to me that you would have to go that far. I'm hoping for some guidance that gives, some safe harbors, that is more about being paid in the 8-week period, and that it doesn't cover more than 2 months worth of costs. I think that could be realistic. We'll see. Next question.
Are there regulations regarding the amount of compensation to owners during the 8-week period in relationship to prior months or years?
This is another great question. I've gotten this question from clients, and there are some clients, where they're not paying themselves more than $100,000 a year, and so the question becomes, hey, should I increase my pay so that I'm getting the equivalent of the $100,000? The equivalent of that on a weekly basis is $1,923. I believe over the 8-week period, it's in the $15,300 change range, somewhere in there. And And the thing I tell clients is you can do that, but we don't have guidance to say whether you can or you can't do that to be eligible for loan forgiveness. So if it's just you as the owner, or if you have a couple owners and everybody's doing it and you understand, okay, there's a possibility that this may not get forgiven and we'll just have to adjust accordingly if it isn't, then okay, fine, go ahead and do it. But I also think there could be a realistic possibility that they could go back to your 2019 tax return and say, hey, what did you actually pay these owners in 2019? And you can't pay them more than that for the 8-week period if it's less than the annual payroll cost of $100,000. So we'll see. I don't think it hurts if everybody understands there's this possibility that, I may have to not get it forgiven if they adopt rules that make me look back to 2019. Next question, please.
If I pay bonuses, hazard pay, or rehiring bonuses, will this be eligible for forgiveness?
Again, another great question. I would think that additional compensation to your employees would not be something that would be frowned upon by SBA and Treasury. I think the hard part might be is if you try to pay them the last couple weeks of June or something, or the last couple weeks of your 8 weeks, for 8 weeks worth of pay, that might be an issue. But a rehiring bonus may not be. I think the only concern I have here is, will it be more than $1,923 a week, the $100,000 annual equivalent? Well, are they going to be looking at that? The SBA and Treasury, or basically your bank ultimately, are they going to be looking at that and saying, okay, is that 100,000 equivalent? Do we look at it on a weekly basis to determine if we paid somebody more than the annual cost of 100,000? So did I pay anybody more than $1,923 in 1 week, including bonuses? Or are they going to take it and say, oh, no, it's not just the 1 week, it's the 8 weeks. So you look at the 8 weeks. Did I pay somebody more than $15,000 in change in that 8 weeks? Again, we don't know. I think if you're going to do hazard pay or rehiring bonuses, there may be a possibility that some of it won't qualify. If it were me, again, I don't know if it would qualify, but I would try to limit it so that it's not more than $1,923 on a weekly basis. Next question, please.
Will the names of all companies approved and participating in the Paycheck Protection Program be released?
Well, this is something I've read recently where there's a group of individuals and I think it came out of, the publicly traded companies receiving these funds that a group of individuals, private individuals, have said that they will request a list of who got the Paycheck Protection Program loans and loan forgiveness, who got that under the Freedom of Information Act. So I think it is a realistic possibility that the name of companies that were approved and participating got loan forgiveness may be released. Next question, please.
Are there clearer definitions of utility costs? For example, are cell phones included?
This is one of those ones where, I'm one of the old guys on this call. I've been around a long time, and, if we go back far enough, when I first started doing tax returns, I don't think many people even had a cell phone. And, back then that was not considered a necessity. That was a luxury. And even until a few years ago, the IRS considered it a luxury and technically required people to have contemporaneous records so that to prove that it was actually used for business, meaning you kept a log of your calls, which was kind of absurd. They have removed that. And so there isn't currently a whole lot clearer definition than what we've already described. But this is one that I'm not sure we're going to get guidance on, because what does the law say? It says telephone. I kind of think in today's environment, most people consider a cell phone a telephone, not just a landline. A lot of businesses, especially smaller businesses, don't even have a landline. They operate off of a cell phone. And their main line goes into a cell phone, or it's one of the owner's cell phone, or it's one of the salespeople's cell phone. So there currently isn't. Again, I may be wrong, but I'll speculate that that's probably something I would feel fairly comfortable saying that probably will get included. Next question.
All of my employees are receiving unemployment compensation benefits because we are not working. Should I start paying my employees with the funds now, or should they just stay on unemployment until we know we are safe to start again and either prepay or bonus them to use up the 75% of the funds for payroll?
This is probably one of the most challenging questions that I think we've gotten. And I'm not just talking for the webinar, but from clients. I've gotten a lot of clients that are saying to me, hey, I'm not eligible, I'm not able to be open. Or I'm able to be open on a very limited scale. What should I do? Should I bring back all my employees? Should I have them be paid by the company? So I use this PPP loan for them. And again, this was one of those questions that Jason went over. I'm really struggling with this one, and I will get their input on this. I want to see a different perspective. But, as we look at this, it's really hard to say to do that unless there are other compelling reasons that Jason talked about, like I have a key employee that I need to keep on the payroll because I don't want to lose them, or for cultural reasons, I don't want to lose my employees. Then I get it. I understand it. I do think it's probably one of those things you should probably talk to your HR attorney. I mean, I hate to throw that we need to speak to them in here, but reality is, there are some HR concerns there if you're paying people to sit at home and not really do anything very productive or anything productive. If you can find things to keep them to do things productive, then I say bring them back, put them on the payroll. It's challenging, very challenging, especially for employees that are making more money on unemployment, right? Most people are aware of this, that, we got employees sitting at home collecting $600 a week extra because of the CARES Act, and many of them are making more than they would be. And I'm talking about lower level paid employees, not necessarily skilled employees, technical employees. I mean, these are employees that probably make less than $50,000 or $60,000 a year. They're probably making less money or making more money, on unemployment than if you bring them back. So it's really challenging. And I know the questions I get from clients are, well, when I'm able to bring them back, what if they don't want to come back? And I'm like, well, technically, you have work for them, and technically you really should fire them. I mean, again, I consult your HR resources, but if they refuse to come back because you have work for them, they're being insubordinate. And technically you should fire them, and then unfortunately you have to fight with them on whether they qualify for unemployment or not. So this is a really tough question. I'm currently debating in my head. I've got a small business with some owners that are taking taking their compensation and need it on a weekly basis. They're barely open, and they have employees, and I'm thinking, well, we're starting to get into this 8 weeks. It's something that I really need to reconsider. Okay, is there some level of payroll I should bring back so I make sure that the employee, the owner's compensation that I'm paying them during the 8 weeks is forgiven? I mean, that's the one thing I'm currently debating. It's been challenging because we just don't know things like how long do I have to bring people back for the get out of free jail card, for their full-time equivalents, and how will that, I pay them less than 25%, and how's that all going to work? I think we have to make some assumptions and put some numbers to a spreadsheet based on what we know to determine, is there some, based upon reasonable assumptions, some level of payroll that maybe we should consider having so that we at least get the owners paid during the 8 weeks. Maybe that's some consideration beyond, paying key employees. I am going to ask if Dan, I'll leave it open up to either one of you two. Jason, if you want to go first, if you don't have anything to add, then maybe Dan, I want to see if there's any other perspective.
Only thing I'll say there, because I don't want to belabor it, since I did kind of address this too in my section, is actually get the polling back up, and you can't make it up. It's split dead even as a yes and no answer, which is it was a question along these lines. So I'll just add that there seems like there's not going to be a right or wrong answer, and it would sure hope they want to clarify things in a way that would be punitive to employers making a decision on either side of this. That's all I'll add.
All right, then we will go on to our next question. Will my payroll dollars be looked at to compare or just the full-time equivalents? I have no problem matching or exceeding dollars I will use on payroll, but many of my part-time employees are cut significantly back on hours worked for now. So my full-time equivalents might not be at the same level. And if it is full-time equivalents, what time period will the next 8 weeks be compared with?
Go ahead, Dan.
Yeah, the easy part is the last part of this question. The 8 weeks are being compared with the 2 look back periods that we talked about in previous slides, either your first 2 months of 2020 or February 15th of 2019 through June 30th of 2019. So we do know those 2 periods. They can be calculated. We can figure out those look backs to understand that. What we're not 100% sure on is what February 15th of 2020 or June 30th of 2020 means for FTEs, because that's that fallback, Robin's reference to the get out of jail free card. That we'll still have to understand. But for this question, the payroll dollars are important to maintain, and that's not the issue. FTEs and payroll dollars are both considered, though. So when you're in a tough situation trying to understand payroll dollar, trying to understand if you can get to your FTEs, my advice would just be let's look at those part-timers that are cut back and try to give them more work, even if it's non-traditional work that we could be working on, doing new things that they might not otherwise be doing. Maybe spreading work from someone who is full-time and maybe working more than 30 hours. They can bring them down to 30 hours, bring some of your part-timers up to 30 hours, just managing whatever you can, and even looking at some hiring. But it sounds like from this question, this person's best bet will probably be to try to get more operations by the June 30th fallback date.
Thanks, Dan. I know we are up against the time. For those of you who can stay with us, we have just a few more questions that we'd like to answer for you. So I have, just like I said, just a few more. Next one, what documentation should be maintained to provide as proof of how funds were spent?
Hey, Jason, you want to take this on, please?
Yeah, so I ended up putting a slide in that you can refer back to that really covers this question, so I'm not going to spend much time there. Other than what's in that slide, you'd really expect banks to probably require payroll reports, summary payroll reports, and I don't know that in the actual CARES Act it listed, maybe it did, lease agreements dated before February 15th. So that's all I would add for now to that slide.
Thanks, Jason. How do we time the forgiveness application to fulfill the requirements to prove that we needed the loan for essential operations of our businesses? Was the statement we gave to the bank enough? Will there be additional requirements for the forgiveness application?
This is a great question. There is, unfortunately, again, it's a moving target. We continue to get stuff every day, comments, as I mentioned earlier, from Treasury Secretary Munchin. And, I do think it doesn't hurt to have people sit down today and start to think about, okay, what was the reason and the need for this Paycheck Protection Program loan, maybe looking at their budgets for the upcoming period of time, and just documenting what they can for purposes. We always feel like it's better to do that now versus later. We don't know on the back end if the banks are going to require some proof of that you really, need this loan for your business or to maintain it. I mean, however that's defined. Nothing so far is saying they require that. Nothing I've seen in any of the rulings from the SBA has said that. But I would say is if there's a bunch more public publicity on this issue, especially with the large companies that receive these loans, that the public feels they are well oiled and don't need these loans, then there may be some more requirements. So that's why I think we would suggest today that it wouldn't hurt to document the reasons for the loan, your thoughts on your revenue and projections for the upcoming year, anything to help today, because your thoughts are always probably the clearest as it happens, not after 8 weeks later. So it's just some suggestion, and I think it's something good that all of us, everybody who applied for the PPP loan should consider doing. Next question.
Thanks, Robin. We've had a lot of questions presented online. I would like to just try to take a few of those right now in the last remaining minutes. Do PPP loans cover paid sick leave?
The question to that, the answer to that is yes, if it is not the Family First Response Care Act family sick leave. So as I mentioned earlier, anything that you are paying in response to the family leave that was mandated through the FFCRA prior to this PPP loan coming around the CARES Act, any of those amounts do not qualify as payroll for purposes of the Payroll Protection Program. So you get reimbursed for those on the 941. Go ahead, Nicole.
All right. Next question. How is related party rent treated in regards to forgiveness?
Again, this is another tough one without any SBA guidance. One would think that arm's length rent between related parties should be allowed. I do think by the fact that they've limited the non-payroll cost to 25%, the risk to the federal government that this could be abusive is probably less. Again, it has to be a lease that was in place as of February 15, 2020. I do think that there is a possibility, again, as I mentioned earlier, with wages, that maybe there'll be some requirement to look back at what you paid in 2019, and it can't be, more than a certain percentage, 110% or something like that, then on a monthly basis of what you paid, you'd have to compare that, to what you paid in 2019. I don't know for certain, but I think there's a possibility that that could be there. I would think that, it seems very punitive if self rentals, that's what we call them, where you rent to yourself, are not included in the lease costs. I think they will be, but there may be some parameters around it. Next question.
Thanks, Robin. This is going to be our final question as we're just approaching that 11:15 hour and want to be mindful of everyone's time. Can we increase owner and related party compensation for the 8-week period?
This kind of goes back to one of my slides where I talked about this, that if you previously weren't paying somebody, an owner at $100,000 or more, it's uncertain whether you could now increase their pay to $100,000 on an annual basis to $100,000 or the $1,923 a week. There's no clear guidance on that. The one thing I would say, as I mentioned earlier, is that it may be allowed or it may not be. And the may not be may mean that you have to go back to, again, like the leases, like I said, there may just be some requirement that says, we understand you pay the owner. We understand there's always a possibility that there could be some gaming going on here. So we'll limit it to what you paid them in 2019. That's what you have to use as their annual wage, and you have to divide that by 52 times 8, and that's what will be allowed during the 8-week period. Again, I don't know. Does it hurt to pay an owner at the $100,000 annual basis? Probably not, as long as there's an understanding that it may not be forgiven. And so maybe you have to reconsider some of your compensation later in the year. So I would say it doesn't hurt, but it may not be included in the loan forgiveness, but it might be.
I'll only add that some attorneys do have mentioned to consider that as maybe self-dealing for that term to run out. So I guess just proceed with caution and hopefully get some clarity here soon.
Thanks, gentlemen. This concludes our question and answer session. I want to thank you all for attending today's webinar. As we mentioned, this was a recorded session. We will be providing the recording and these slides. We'll make them available after today's, at the conclusion of this webinar. We will also circle back with the remaining questions that we weren't able to answer and make sure that we get each of your questions addressed appropriately. We ask that you please continue to stay in contact with your Trout contact manager, and stay tuned. There will be another webinar as soon as we get the guidance that we for the CARES Act that we've been waiting for. Thank you again, and stay safe and have a great day.